Hello, everybody. John Jameson again. Hey, listen, I just wanted to shoot a quick video to talk about a Roth conversion. And then, maybe more importantly than that, is a life insurance conversion, which is much less talked about than a Roth conversion. So, one of the biggest questions we get is, hey, should I convert my Roth IRA? And if so, should I convert it to a Roth or should I maybe convert it to a life insurance conversion? We're going to talk about both of those today and what the differences are, benefits of both. All right. Um, what is first of all, what is a conversion? Right. It's nothing more than taking money out of your traditional accounts now, paying the income tax on it, and then putting it into a Roth style account because the Roth now is not taxable for the rest of your life, and your estate can inherit it and not pay any tax on it. Okay. So you withdraw the money, pay the tax that particular year, and then put that money over into a Roth IRA account. Okay. Why would you do that? Well, hopefully to get taxes out of the way now at hopefully a lower rate than in the future, right? Because that pool of money that your 401k or IRA has, all of that is taxable. And it's taxable when you take it out. So if you think taxes are going to be more in the future, as many people do, sometimes you want to get the taxes out of the way as much as you can today. Okay. Then you want to take those funds and put it into a tax free account for the rest of your life, and also money that can go to your estate tax free to them. One of the side notes of whether you do a Roth conversion or not is you generally want to have the money that you're going to owe in taxes, you want to have in another account somewhere. Now, you're generally going to do these conversions over a period of time. We're going to use the 10-year example. Okay. So, whatever money you're going to owe that particular year when you withdraw money out of the traditional account, you generally want to pay that somewhere else. So, you have all of the money that you took out to put in the Roth to make the most advantage of tax free compounding and the tax free growth in the account. Okay. So, should you do a Roth conversion? All right. The answer is yes and no, right? It's yes if you think you're going to need a portion of the money being converted for retirement. In other words, if you don't think you're going to need it, you've got a pile of money over here, you're already living a good life, and you're probably going to leave that money. You have plans to leave it to your estate, maybe kids, grandkids, nieces, nephews, causes, charities, whatever. But you don't really anticipate you're going to need that particular chunk of money. Okay. The answer is probably no if you're either near, at, or already in retirement, and that's because the time it will take to break even on the money you will lose to today's taxes that you're going to pay. Okay. So if you need that pile of money or you're already using it and you're taking an income draw from it, that's really what it's for. Don't feel bad about it. Live your life, have a great retirement. That's what you work for. But you basically need that money to do that. Most of the time, and again, you have to do your own math, and we're not going to do that obviously on this quick video. But most of the time, it's not worth the conversion if you're going to spend most or all of that money anyways during your lifetime. Okay, so do your own math, but generally, if you're using your own traditional funds for retirement income, stay put with the traditional. Okay, now what you might want to consider doing is repositioning some of that money, keep it in the traditional style account, but maybe we're going to move it to an account that will protect it. So if we have a 20, 30, 40, 50% downturn like we did back in '08 that took 7 years to recover from, that you don't participate in that loss, because that can be devastating if you lose money at that particular time of life when you're in the disbursement mode. So whether or not you convert to Roth or not, you may want to consider repositioning that account. And that's something we have videos on, and we can talk about more about that on a personal call, but just something to throw out there. Okay. So if you don't intend to use that money during yours or your spouse's lifetime, then a conversion could be a great call. You're generally going to maximize more of that account if you're not worried about having to break even on it in a specific period of time and using that money to for retirement purposes on your own. So generally, if you don't need the money, conversion is probably a good way to go. If you do need the money and you're already using the money, then it's probably not the thing to do for you. Okay. So benefits of a Roth conversion. Okay, potential huge tax savings in the long term. If you let this account go out 10 years, 20 years, 30 years, and you don't have any tax on it, well, the traditional account, if that's growing at the same rate, that's building a huge internal tax obligation. And when either you or your estate starts taking that out, it can affect the taxes on the other money that comes into your life. Okay. You'll generally end up with much more money for your estate, and it's given to them in such a manner that if they want to, they can let it compound for their lifetimes as well, creating really a ton of tax-free money because you got the taxes out of the way earlier in the entire program. Okay. Also, when your estate inherits a traditional account, they changed the rules a couple of years ago where they have to withdraw all of that money in 10 years. So let's just say there's $250,000. You've got one child and you left it to them, and now they've got to withdraw 10% of that account value every year. So let's just keep the math simple. They're going to take out $25,000 a year. That $25,000 goes on their income. And if they're already a high income earner, you're really going to pay the maximum tax possible on that particular account. Now, if they don't make that much money, then it's probably not that big a deal. Okay. But just something to keep in mind that it's called an inherited IRA, right? Well, when you inherit a Roth, there is no such withdrawals. You don't have to take everything out over a 10-year period because the money's already been taxed. Okay. So you have tax-free growth and payouts for your heirs' lifetime, potentially saving them big money in taxes. And again, if your estate if your kids, let's say, they're already high income earners, probably going to hurt their tax situation in those 10 years that they have to do those mandatory withdrawals. Where if you've got the taxes out of the way now, they don't have to worry about it. They can either use it, not use it, take it out as they like. They're not forced to do that draw. So maybe they're going to hold on to the money till much later in their lives when they're not making as much money and now start to use that to help them with their retirement, expenses for your grandkids, those kind of things. Okay. So if you're using that money to increase your estate and you're not going to spend it, then maybe you want to take that money out of the Roth and fund a life insurance policy with it instead. Okay. So the main benefit of a Roth conversion is to pay the taxes now, right? Your estate doesn't have to worry about them. So the reason you can do that is because a Roth is a tax-free environment. Well, so is what's called a high cash value life insurance. The growth in that during your lifetime is also tax-free, but there's also one huge thing that you don't get with a Roth IRA, and that's obviously a death benefit. And that death benefit is going to go to your estate when you pass away, and it's going to be 100% tax-free to them. Okay, so this is a way to take that retirement money and leverage it even further on a guaranteed tax-free basis and leave more money behind for kids and grandkids. Maybe it goes into a trust and you decide, how much each year a kid can take out or the grandkids, or set it up the way you want to set it up, or just leave it to somebody and let them worry about it. You can do either one. Okay. Now, during your lifetime, if you ends up that you do need access to the cash, that life insurance policy has high cash values starting from day one. So you'll have access to most of that money should you need it. But remember, the plan was you don't think you're going to need it and you're trying to maximize your estate. Okay. So the premiums leverage life insurance to leave behind more tax-free money to your estate than might otherwise happen with just the growth of the money. All right. Now I'm going to give you a quick example here. So again, let's say you're going to convert $250,000 from a traditional account. Again, we're going to probably do this over 10 years to minimize we generally don't want to take $250,000 out the first year, pay massive taxes on that and all your other money. So let's just say you're going to do it over 10 years, be a little more strategic about it. That's $25,000 a year. So when you take out the $25,000, let's just say for easy math, you owe $5,000 in taxes. You've got the $5,000 in a savings account. You pay the taxes on it. Now you take that $25,000, put it into a high cash value life insurance policy. Okay. Let's say you're going to do that for the next 10 years. So you're scheduled to put in $250,000 of premium over the next 10 years. Immediately, now this will depend on your age. It'll depend on your gender, your health. There's some certain issues, obviously, right? Nothing's going to be the same. But for this example, let's say the $250,000 bought you a $450,000 death benefit. And that death benefit, always remember, is always going to be tax-free to your estate. Okay. So whenever you die in the future, your family gets the death benefit of $400,000 and they get that 100% tax-free. Worst case is you put in $250,000 and you leave behind $450,000, and maybe it's a long time in the future. So the actual growth of the 250, maybe you would have done better somewhere else. It all depends on kind of when you die and what the rates of return would have been. There's some factors that we just don't know. But I do know once you put the money inside that life insurance policy, it's going to give you a death benefit. And that death benefit is guaranteed even if you pass away early, right? And we're going to talk about that, even if you haven't funded the full 250. Okay. So let's say you die a little earlier than expected. You're in the year 5, you just paid in your 5th year of a conversion style. In other words, you're taking the money out over 5 years, taking it out over 10, but let's say you pass away after the fifth year. Okay. So you've put in $125,000 of premium. Guess what? Your family still gets the $450,000 death benefit, even though you didn't put in the whole 250. And the 125 that's left in the traditional account, because remember, you only took out 125, that 125 also goes to your estate. Okay, now that one, they'll have to pay tax. They'll have the RMDs that we talked about, the required minimum distributions over 10 years. But they're going to get the 450 cash tax-free and another 125 taxable. Okay, so between the $450,000 and the $125,000 in this example, they get $575,000 total payout, and you only put in $125,000. That's not a bad place to put money. The only make that, but what has to happen for that to look really good is you have to pass away early, which nobody wants. We're just using this as an example. Okay. If you live a long time, the rate of return on that obviously goes down because it's longer before that death benefit gets paid out, but it is guaranteed for the rest of your life. In other words, that 450 is guaranteed. It's not subject to any market issues, anything. So whatever that death benefit is, you know your family is going to get that, and is generally going to be considerably more than you put into the account in the first place. Okay. Also, there's some quick side benefits of that. If life changes and you need long-term care, or you need a nurse to come in to help you, and that you need that for an extended period of time, and it gets very expensive. Guess what, folks? You can access that $450,000 death benefit during your lifetime to help you pay for those expenses. Now, that's something we hope we never have to do. That's not the goal with setting this up, but it certainly is a nice side benefit that you might end up using in the future, right? And that's why some people will do two of these kinds of policies for each spouse, so they both have that potential long-term care protection. But that's something we can talk about more on a personal level on a phone call. Okay. Okay, so consider rolling over your qualified account to a fixed indexed growth annuity for principal protection. So let's say you've decided to do this, and it's going to take 10 years. You're going to withdraw the money over 10 years. You want to make sure that initial $250,000 in this example, or $2 million, or whatever it is protected and not subject to big downturns. So one of the ways you can set that up is to put it into a fixed indexed annuity. That money can still grow. It'll be tied to maybe the S&P 500, so you got a potential for some strong growth during your 10 years, but you can't lose any money. So if the market does go down big year after year, or even 1 year, you don't lose any money that particular year. It's a great way to be able to count on the money that you're going to be able to pull out regardless of what the market does. If the market does well, you'll pull out more money. If the market doesn't do well, you're still going to pull out that initial 250 worst case scenario. Okay. Then what would happen is once the money's over into the fixed indexed annuity, you do 10% withdrawals out of that account and fund your life insurance policy. Okay. Or you fund a Roth. You can also fund a Roth IRA with the same way. You basically protect your traditional by rolling it over into the fixed indexed annuity, and then take advantage of 10% withdrawals. And if you don't want to do the life insurance, fine, fund the Roth account and let the Roth invest and do what you were going to do anyways, but protect that money that you have now, because you don't want any big downturns when you're in the process of doing this. Okay. Let me see. That's really about it for today, guys. I mean, we could get much more in depth, but I just wanted to paint a general picture and let you know, hey, this stuff is available. So if it's something that you'd like more information about, send me a direct email. You see it right there on your screen. John D. Jameson. Make sure you put JAMIESON. A lot of people forget the I or the E. We need both in this one. johndjameson@gmail.com. Let me know you saw this video and you want more information. I can send you extended videos of very specific topics that we talked about in here, or we can just have a phone call. We can do both. All right. So thanks for stopping by today. It's been my pleasure. We'll look forward to seeing you on another video and talking to you in person. Bye-bye now.